Silver didn't pull back on Friday. It didn't correct. And it sure as hell didn't cool off. Silver was slammed, over 30% erased in a single trading session. One of the most violent collapses in modern precious metals history. Silver was trading near $122 earlier in the week. By Friday, it printed below $75. That's over $40 gone. Not over months, not over weeks, in hours. Gold wasn't spared either. Gold dropped to around $4,714 an ounce, its largest single-day loss since the early 1980s. Nearly $900 wiped out at the highs. And here's the part that should already make you uncomfortable. There was no war, no pandemic, no terrorist attack, no bank run announced on CNBC. Nothing broke on the news wires. Just silence. And yet, we just witnessed one of the largest one-day crashes in precious metals in decades. Before we go any further, yeah, this is where I borrow the AI Asian guy lines. Do yourself a favor. Close the door. Tell the neighbors to stop yapping. Grab your coffee. Sit properly. And remove every distraction you can find. If someone is talking to you right now, even your wife, politely ask them for 5 minutes of silence, because this is not something you listen to halfway and move on. And trust me, you'll want to hear every word of what comes next. What you're about to hear explains exactly why this keeps happening, who benefits, and why if you're a physical silver holder, Friday was not what it looked like. Let me ask you something simple. If silver crashed because investors suddenly got scared, why did physical silver not flood the market? Why didn't vaults empty from panic selling? Even though the answer to this is simple enough, the vaults were emptied ages ago. But that's not what this video is about. Why did Shanghai silver trade near $120 to $130 an ounce at the same time COMEX silver was collapsing into the low 80s? Same metal, same day, two completely different prices. That is not volatility. That is a fractured market. The cover story you were told this was about two things. First, CME Group raised margin requirements. Second, Trump nominated Kevin Warsh, an inflation hawk, as the next Fed chair. That's what headlines want you to believe. But those are not causes. Those are tools. On January 30th, CME quietly dropped the hammer. Silver margins jumped from 11% to 15%, gold from 6% to 8% platinum, and palladium hit too. And here's what most people don't understand. Margins don't cool markets. Margins force selling. When you trade futures, you're not paying full price. You're leveraged. That means you're borrowing exposure. When margins jump, your broker calls you and says, you need more cash today, not next week, not tomorrow, today. If you can't post that cash in hours, your position is sold for you. You don't get a vote. Now picture this happening to thousands of traders simultaneously, right into month end, right into record volatility. That's not a market correction. That's a forced liquidation cascade. Why Friday was so brutal. Friday wasn't just any day. It was the last trading day of January, right before new margin rules take effect after silver had already gone parabolic. This is when leverage is weakest. This is when clearing firms get nervous. This is when the exchange protects itself. So what happened? Massive blocks of paper silver hit the market at once. Not retail traders, not profit takers, institutional size. Millions of ounces dumped in waves. Silver broke $100 like it wasn't even there. Then $90. Then $85. Stop losses fired. Margin calls exploded. Accounts were liquidated automatically. By the close, silver was sitting near $83 after printing sub-75 intraday lows. That is not natural price discovery. That is the system pulling the eject lever. And here's the part they don't want you thinking about. Silver didn't collapse because demand vanished. Silver collapsed because paper claims met physical limits. At the same time COMEX was imploding. Registered silver inventories were falling. Millions of ounces were being shifted out of deliverable categories. Delivery notices were rising in what's normally a quiet month. And most importantly, no massive physical selling showed up. No vaults drained from panic. No flood of metal hit the market. So ask yourself, if people were really dumping silver, where's the silver? What this means for you. The silver stacker, if you hold paper silver, Friday was a warning shot. Paper silver can be margin called, can be liquidated, can be crushed by rule changes overnight. Physical silver, It doesn't get phone calls. It doesn't get liquidated. It doesn't care what CME decides. You either have it or you don't. And while Western markets were blowing out paper positions on Friday, physical silver kept moving east. Shanghai premiums exploded. Bars were being removed from vaults. Real metal changed hands, quietly, deliberately. Paper collapsed. Physical didn't. So if Friday wasn't panic, if it wasn't fundamentals, if it wasn't just a correction, then the real question becomes, who needed silver lower, urgently, and why? Because what happened next inside COMEX delivery data tells you everything. Now here's where this moves from price action into plumbing. Because what happened on Friday didn't occur in a vacuum. It collided head-on with COMEX delivery timing, and that's the part most people are missing. March is a major silver delivery month on COMEX. And as we move toward first notice day, shorts who are still open don't just face mark-to-market losses. They face the possibility of standing for physical delivery. That's when leverage suddenly becomes very real. So what does a 27% collapse in the March contract right before delivery actually do? It forces weak hands out. It flushes leveraged longs. And most importantly, it resets open interest at precisely the moment when physical settlement risk would otherwise peak. This is where margin hikes stop being a neutral risk management tool and start acting like a timing mechanism. CME raises silver margins from 11% to 15%, gold from 6% to 8%, right after the most violent two-day move in decades. Not before, not during the melt-up, but after prices break. That timing matters, because higher margins don't punish shorts sitting on warehouse metal. They punish leveraged longs who need cash now or they're out. And when longs are forced to liquidate into thin liquidity, price doesn't fall, it air pockets. Now let's talk about JPMorgan, carefully, factually, and without theatrics. JPMorgan has long been one of the largest participants in COMEX precious metals, both as a clearer and as a vault operator. That's not speculation, that's disclosed structure. What's interesting isn't conspiracy, it's calendar alignment. The violent sell-off lands, days before first notice, during record open interest, amid delivery anxiety, and right as margin requirements jump sharply, which results in fewer contracts standing for delivery and a calmer settlement window. Market veterans will tell you, COMEX stress doesn't show up in headlines. It shows up when delivery pressure quietly disappears after chaos. And notice this too, despite the crash, silver still closed January up 19%, and year-to-date it's still up roughly 170%. That's not a broken market. That's a market being force reset. The question now isn't, was this profit-taking? The real question is, backhand index pointing right, was this liquidation, or was it risk being surgically removed before delivery mattered? Because if this were just a speculative blow-off, you wouldn't need margin hikes. You wouldn't need panic liquidation. And you definitely wouldn't need it right before physical obligations come due. And in a moment, when we get into the expert clips, you'll hear why this kind of event often doesn't mark the end of a move, but the clearing of the runway.
Two comments to make about this board here. The first one is, why is this happening? Well, the catalyst that you're going to read about in the press, and it's largely correct, is that Trump has announced, he pretty much has announced he intends to put a more hawkish person in the Fed, and that's one of the reasons that metals have gotten dropped. But it's also a reason, and it's also a reason for the dollar being stronger, and it's also a reason for stocks to be lower. That's a catalyst, not a reason, but it's a good one and it's legitimate. The second thing I want to draw your attention to is the VAT tax on silver has come up again. Now, there is a VAT tax that's reflected in the differential in prices between Shanghai and COMEX. There's no doubt about that. At least I don't think there is a doubt about that. However, people are continually debating if silver has a VAT tax involved in it. Now, I could be wrong. I'm not married to this. I'm not in China. Something could be lost in translation for what I've been told. But I've been told that the VAT tax is negotiated after the fact. You do not broadcast global price if you can get away with it, number one. Number two, VAT tax is also negotiated afterwards because it's not necessarily true who's going to be paying the tax. Now, this is information gotten from Bai Jiaojun, mainland China, and it's gotten from Eric Young, who's very well versed in the physical structure and is in deep in Hong Kong. So to reiterate, it could be wrong, but I'm 99% sure that this is how it works. The futures price does not show the VAT tax. That's the price they broadcast to the world. $99.99, tax not included. And then when you buy, and someone agrees to sell, you negotiate. Sometimes one guy pays the whole VAT tax. Sometimes the buyer pays the VAT tax. Depends on your relationship and how it works in the middle. That's the first thing. The second thing is, anecdotally, based on experience and observation, if the VAT tax is a percentage of price, well, then as the market rallies, the VAT tax should increase and the spread should increase. And sometimes it does, but sometimes the spread between New York and Shanghai narrows in a rally. So that's just not true. And when the market drops, the spread should decrease because the underlying price, the notional price, has dropped. Therefore, the tax should decrease. But frequently, not all the time, frequently, the price will widen. The spread will widen as the market drops. That is not a tax. That's a demand in China and a supply in the US. So you could continue to debate it, but I just wanted to say that again. Eric Baijiaojun and my other third-party recon, as well as my observations. Why would I pay more tax on an asset that's dropping? Does it make sense? Anyway, and if you're looking at that 130 and it's closed right now, so it's lower than 130, but the spread's probably not coming in. If it comes in, then fine. Then you can make that case, but I'm still not going to make that case. Demand destruction happens when markets stop working, not because people stop wanting an asset, but because they cannot access it, afford it, or participate normally. Right now, gold is seeing volatility-driven demand destruction, where options are too expensive to use. Silver is facing an emerging physical supply chain breakdown, I should say, from cash-constrained market makers to refinery bottlenecks and empty dealer shelves. When participation fails in the supply chain, markets cool, volatility rises, and speculative positions get flushed like they have been and continue to be right now. Demand destruction is when markets fail due to broken access, pricing, or mechanics, not because they don't want to buy it. Gold is experiencing a demand destruction on the option side. Volatility has made options too expensive to use, shutting down speculation. What does that mean? It means if you buy a call, it's just too expensive. And if you buy a put, when the market rallies, the put's going to go up in value. And when the market drops, the put's going to go down in value. Options cease to work when volatility is this high. You need to do spreads, options against options, call spread, put spread, not call or put. Silver is more interesting and very, very rare in the metal space. There's a cash strain. There are refinery bottlenecks, and there's low inventory that are disrupting physical supply, pushing buyers to proxies.
What Vince Lanci just laid out is critical because it reframes this entire episode away from headline-driven narratives and back toward market structure. Yes, Trump's intention to nominate a more hawkish Fed chair is being cited everywhere as the catalyst. Vince is correct to call it exactly that, a catalyst, not a cause. Catalysts explain when something happens, not why the market was vulnerable in the first place. The VAT argument is where things get especially revealing. If silver's Shanghai premium were simply a tax effect, then the spread should behave mechanically, widening as prices rise and narrowing as prices fall. But as Vince points out, the opposite frequently occurs. The spread widens during price declines and narrows during rallies. That is not tax math. That is physical demand colliding with constrained supply. A tax doesn't behave emotionally. A tax doesn't respond to urgency. A tax doesn't tighten when inventory disappears. What does? Real buyers needing metal. And this matters because it introduces something we hadn't discussed earlier in the video: demand destruction versus demand displacement. Vince makes a subtle but vital distinction. Demand destruction doesn't mean people stop wanting gold or silver. It means they can't participate normally. Options become unusable, liquidity vanishes, market makers get cash constrained, refineries bottleneck, and dealers run dry. Gold is seeing this on the options side. Volatility has broken the derivatives mechanism. Silver is seeing it on the physical side, where supply chains are straining and buyers are being pushed toward proxies because real metal is harder to source. That combination is extremely rare. It also directly rebuts the idea that this sell-off has anything meaningful to do with Trump's Fed pick. If this were truly about a hawkish Fed future, you wouldn't see refinery bottlenecks, cash-strained market makers, widening Shanghai spreads during price drops, empty dealer shelves. Those are plumbing problems, not political reactions. Politics gives the market an excuse. Structure determines the outcome. And this is where Peter Schiff cuts straight through the noise. The crash in gold and silver today has nothing to do with Trump nominating Kevin Warsh to be Fed chair. If Trump thought Warsh was going to be a hawk, he would not have picked him. Plus, even the most hawkish FOMC members are still doves. Politically, there is no alternative. Schiff is pointing out something Wall Street prefers not to acknowledge. The range of acceptable policy has already collapsed. Even so-called hawks operate inside a system that cannot tolerate genuine monetary tightening. He continues, "It makes no sense that Trump picked Warsh because he will be a monetary policy hawk. Trump wants to get rid of too late Powell because he isn't nearly dovish enough. So if, for some reason, Trump didn't realize his pick is a hawk, there is still time for him to change his mind." In other words, the idea that markets suddenly repriced gold and silver because of a future Volcker-style Fed is fantasy. The system is structurally incapable of it. Then Schiff goes one level deeper. What if Trump wants a Fed chairman to do the right thing, but wants to publicly criticize him for doing so? That way he has the Fed as a scapegoat for all the problems doing the right thing will cause in the short run. If so, then all of his criticism of Powell is just an act. Whether you agree with Schiff or not, the implication is profound. No matter who sits in the chair, the Fed becomes the fall guy. And markets know this, which is why blaming a metal crash on a personnel announcement is intellectually lazy. Now here's the part that should not be ignored. As expected, a bank collapsed. Not a major one, not a headline-grabbing titan, a small regional bank. Exactly how systemic stress always begins. As expected, a bank collapsed today. Trust me, this is just the beginning. Gold and silver are just a distraction. The real shift is happening elsewhere. Protect your money. This is how financial crises announce themselves, quietly, inconveniently, and easy to dismiss. Regulators and bankers will never give the full picture early. They wait until denial is no longer possible. But early failures matter more than late ones, because they reveal where stress first breaks through the surface. And silver sits right at the intersection of this stress. Leveraged futures markets, fragile collateral chains, industrial dependence, shrinking physical availability, whether you interpret that as coordination or opportunism, the result is the same. Price was smashed where liquidity was weakest, not where fundamentals were strongest. So let's take stock. Silver didn't collapse because demand disappeared. It collapsed because participation broke, leverage got flushed, and exchanges pulled every lever available to regain control. Banks are cracking at the edges. Physical supply chains are tightening. Derivatives are malfunctioning. And price is being used as a blunt instrument to manage stress. Yes, it's infuriating how aggressively banks and exchanges are willing to intervene just to suppress silver. But here's the difference this time. They've played this game for decades when silver had no structural backing, no industrial choke points, no global supply tension, no collapsing trust in collateral. That's no longer the case. Silver is fighting back, not in headlines, not in price candles, but in availability, spreads, delivery stress, and institutional anxiety. The takeaway isn't panic. It's awareness. Watch delivery. Watch inventory. Watch who can still participate and who can't. Because when markets stop working normally, price becomes the least important signal of all. If you've made it this far, you already understand something most market participants still don't. What you're watching is not a normal correction. It's not sentiment. And it's definitely not about one Fed nominee. It's about stress being managed, leverage being crushed, and time being bought. The same playbook that's been used for decades. But this time, the backdrop is different. Physical silver is tighter. Supply chains are fragile. Banks are cracking at the margins. And price suppression is no longer happening in a vacuum. It's happening against real-world constraints. So don't watch the headlines. Watch delivery. Watch inventory. Watch which markets stop functioning normally. If you're stacking, stay disciplined. If you're investing, stay patient. And if you're new here, now you know why silver never moves quietly and why it never stays suppressed forever. If this breakdown added value, like the video, Share it with someone who still thinks this was just a hawkish Fed story, and subscribe if you want clear-eyed analysis instead of surface-level narratives. More signals are coming, and when they do, we'll be here, breaking them down properly. Thanks for watching, and see you in the next one.